Hello and welcome to another episode of Darwin Investors. Man, we're doing it. We're going to the moon, folks. I closed out at my all-time high this week again. I'm up 3.55% for the year, which doesn't sound like much, but at least that's way better than the S&P 500. And I don't understand why these videos can get thousands of views and thousands of likes or whatever, because basically I'm laying out the blueprint on how to beat this market. It doesn't matter if the market's going down. It doesn't matter if the market's going up. I'm showing you how to make money. I do it by putting money in every couple of weeks. I do it through options, and I understand these things aren't always easy to understand. It's sort of like getting into like a TV show that's difficult to get into, or a movie, or maybe a band puts out an album that's kind of not very accessible. It takes a little bit of work to get into it. But once you do, you get rewarded. And there's certain things I can't control in this life, but one of them I can seem to control is how much money I make in this stock market. So yeah, for those of you that are tuning in, thanks a lot for doing so. But before I get started, I gotta give a shout out to my sponsor real quick this week. Guys, do you think you can't sing and dance? Do you find some women unattractive? Do I ever have the cure for you? That's right, it's my sponsor this week, which is beer. I gotta admit, I like that. All right, let's get into this video. So, when did we become the smart money and institutional investors become the dumb money? Did COVID really screw everything up that bad? I mean, I don't understand what's going on here. Maybe it's the way it's always been. I've only paid really close attention to this for the last couple of years. But retail investors are continuing to buy the dip in tech despite recent market turmoil. Of course we were. This was dated May 11th, 2022. We're buying them because they were the best companies in the world. Are retail investors driving the stock sell-off? This was dated June 2nd, 2022, 2 weeks before the market low. They're saying that looking at the gross levels of activity, we see that retail has remained active during recent volatility, at least for the segment of retail trading that we capture. Of course, we're buying the low. We're buying in because if we look at the charts over time, you buy when things go down. That's what you do. That's the way you make money in the long run. We've not have been investing then, but we at least can look at a chart and know that's when you're supposed to do it. They don't seem to know it. Retail investors are sticking with the US stock market so far. This was dated 20 May 2022. But do you know who was not sticking with the stock market? That's the opposite of professional investors, he says, most of whom have already exited the market. They exited in June and now they're buying back as things are going up. So they're selling at low and buying high. This is the opposite of what you're supposed to do. When did they become dumb money? And even when they did decide to buy, it was like, well, we're going to go ahead and we're going to buy Hershey's and Kraft Heinz and Procter and Gamble and Johnson and Johnson. And we're like, well, Apple's down 30% from its all-time highs, and so is Microsoft. Amazon and Google are both down 40%. They're the ones with all the money. If we're worried about inflation and interest rates and borrowing, these companies don't need borrow money. They have all the money in the world. Why are you worried about these companies? Well, we think we should just go ahead and buy Bristol Myers Squibb and Eli Lilly because they're sitting at all-time highs right now. And energy stocks and consumer staples and utilities, they're not range bound or anything. They can continue going to the moon. We didn't learn anything from Enron. And we're like, have you guys lost your dang minds? But now things are starting to turn around and they're starting to come around to being able to invest in better companies, which is why we're starting to see our portfolios rise, because we've had the better companies all along and we were buying more of them when the market was low. And so the CPI index came out this past week showing that the CPI increased 8.5% year over year, which was better than the 8.7% expected and way better than the 9.1% we had last month. However, still very high historically, we understand. But we're expecting that this is going to come down significantly more next month because the PPI came out a lot softer than what was expected. We were expecting a fall of 0.1% in July. We got a fall of 0.5% in July. And what that means is that since it is a lot cheaper to make things, it's going to cost us less to buy things next month, which means that inflation should come down. And we also got a lot more good news because we got a 50% retracement of the S&P 500. And what that means is that since 1950, since they have been tracking the statistic, when the stock market goes to an all-time low and then retraces 50%, you don't visit that all-time low again. Doesn't mean it won't go back down again. So the 50% retracement of the bear market sell-off is encouraging, but reasons remain to be cautious. So let's look at this little chart here. So we had the 50% retracement. So we go all the way down and we see we go all the way down here to like 3,600 and now we bounce up over the top. Historically, through every bear market, we've had 9 since 1950. This is the 9th. When this happens and you get a 50% retracement, it doesn't mean it won't come back down. It just means it won't go below this. And what this means to me personally is if it comes back down to 3,700, 3,800, I'm going to margin out. I'm going to get the best companies in the world. I'm not going to go out and get Bristol Myers Squibb. I'm actually going to get the best companies in the world. They're going to be down an extra 20% from here, and I'm going to ride them back up just like I just did. Heck, I put out a video. I bought Amazon way down at like 108 bucks and I sold those and made a bunch of money. And so that's what I'm going to do. I'm going to buy in very, very heavy down here. But this article goes on to say that we are not out of the woods. And I'm going to show you why. And I totally agree because I kind of was like a little bit nervous a little bit earlier last week because of some information that come out that I'm about to get into in just a second. Krinsky cautioned that previous 50% retracements in 1974, 2004, and 2009 all saw decent shakeouts shortly after clearing the threshold, meaning that this could come down pretty sharply right here. All this means to me is if it comes down to here, I'm going to be buying more and I'm ready to go. I've sold some stock. I've restocked up the war chest. I'm ready to get going. It might be selling puts. It might be buying stock and watching it go higher and selling it later. I've not decided how I'm going to do it. I need to see how this market's going to play out. You know, the market is it's got a flow to it and you got to kind of go with the flow. So further, as the market has cheered peak inflation, we are now seeing a quiet resurgence in many commodities and bonds continue to weaken. And so I put up this little chart here, and what we're talking about is this. I'm going to show you a little bit what happened last week, and this would be the bear case for this market. So here's the bear case, because I'm always good about presenting a bull case. I don't often present much of a bear case, but here we are. Because, well, honestly, lately it's been hard to present a bear case. There hasn't been much to be down about. We've already been as far down as you can get. Where else have you got to go but up? But here is a bear case for going down because now we are going up, and that's the reason why I sold some stuff. I'm ready for a little march down. I'm ready to come back in very much heavy. And so when I look at oil here, if oil goes up, commodities go up. And if commodities go up, inflation goes up. If inflation goes up, the Fed sees that they need to hike interest rates even further. And if the Fed needs to get more hawkish, the stock market will go down. But that's not the pattern we've been in. What we've been in is oil has been coming down. Since oil goes down, commodities come down. And we're talking about food, like anything comes down. Like oil is a driver of everything. If you go to the store and you buy a pack of hamburger, it took oil to get it to the store. Oil drives everything. So if oil comes down, commodities come down. If commodities come down, inflation comes down. If inflation comes down, the Fed will either not hike rates at all or cut rates down from where their current levels are. If the Fed remains flat or cuts rates, the stock market will go up. But the key driver in all of this is oil. Is oil up or is oil down? So this past week, Oil has had an up week. Last week on August 4th, it was sitting at $88. By week close, it was at $92. A lot of that had to do with this IEA hike of 2022 demand. They gave a growth forecast showing that we were going to need to use more oil. And the reason why we're going to need to use more oil is because oil is now cheaper than natural gas. And we need to heat homes around the world, and we need to do it cheaper than buying natural gas at whatever it is in Europe right now, which is like 200 something dollars of whatever they measure natural gas in. So oil prices rose by over 1% on Thursday after the International Energy Agency raised its oil demand growth forecast for this year as soaring gas prices drive some consumers to switch to oil. Natural gas and electricity prices have soared to new records, incentivizing gas to oil switching in some countries. And they're talking about heating homes with oil this winter rather than with natural gas. However, OPEC then the day after on August 11th said, hey, oil demand is actually going down. And so we're not going to have to raise the prices as much as you think we're going to have to. And so when they dig into this, they say that the world demand growth is to slow to 3 million barrels in 2022. It contrasts with IEA, which raised its demand outlook. Essentially, no one knows who to believe here right now. However, this short-term outlook of energy from the EIA shows that what we're projecting for gasoline prices from now until the end of the year, the U.S. retail price for regular grade gasoline averaged $4.56 per gallon in July, and the average retail diesel price was $5.49 a gallon. It's expected that the gasoline price will drop to $4.29 in the third quarter and fall to $3.78 in the fourth quarter of 2022. Diesel prices are also expected to drop to $5.02 a gallon in the third quarter and $4.39 in the fourth quarter. So we are expecting gasoline prices to come down here in America. OPEC is expecting that there's going to be less demand for oil, while the IEA thinks it's going to be an increased demand due to heating our homes in the wintertime. We'll see who's right. Is it going to be the IEA or is it going to be OPEC? But either way, it's going to be something I'll be keeping a very close eye on going forward, just in the market, just to kind of determine whether or not things are going to be going up or down. All right, so retail earnings come up this week, and this is a huge week for me, and this is one where I try to make quite a bit of money. On Tuesday, Home Depot reports. On Wednesday, Lowe's reports. I am a shareholder of Lowe's. Citigroup did recently downgrade them, and all they've done since this downgrade is go up $7 a share. It's because their downgrade didn't make any sense. What they said was that new home building has gone down. Lowe's doesn't have that many professional contractors. So therefore, Lowe's should go down because home building has gone down. However, Home Depot remains unchanged because they have plenty of professional contractors. I don't understand their logic, and apparently neither did Wall Street, as Lowe's surged, as did Home Depot. Lowe's and Home Depot, I think, could surprise because we're finding that mid-level and high-level earners do not seem to be slowing down on buying things. And also because if you're not going to buy a home, you may be taking out a home equity loan on your existing home to remodel your kitchen or your bathroom or whatever, to make the place that you're in the place that you wanted to be in if you were going to sell and go into another home. So I would expect that these two could actually surprise to the upside. Walmart also reports on Tuesday. Walmart did have problems with inventory. They had an inventory glut. We'll see if they're working through it. That's going to be pretty much a window into what the Target is going to report. Walmart is also got, they said they're going to get into streaming, and I don't know what kind of videos they're going to make, but if they just put up little cameras in their stores, we could get probably some pretty entertaining videos of people beating their children, I guess. I don't know what kind of streaming they're going to get into, but we'll see. But I don't know that streaming is something I would want to get into, considering that all of the streaming companies seem to be doing pretty poorly right now, and companies such as Apple are doing really well in every other part of their business. However, their streaming is probably the one area they probably wish they could subtract. Also on Tuesday, Macy's is reporting, and that's what I'm going to be making a play on. I'll get a little bit into that further on in this video. Target, I've made a play on for a couple of very good reasons. TJ Maxx, I've stayed away from. On Thursday, I'm going to be making a play on Tapestry because Capri just posted a really good set of numbers. So it would follow that Tapestry, being a very similar company, would also post very good numbers. Also on Thursday, after the bell, Applied Materials will be reporting. All of the semiconductor producers have been doing really well. Taiwan Semi, Kulicke & Soffa, On Semi, they've all been doing really well. I would expect that Applied Materials would do well after the bell on Thursday. I'd probably sell a put there. And then on Friday, we've got Foot Locker reporting. And also not listed on this, we've got John Deere. John Deere is screaming higher, just like Caterpillar did going in earnings, only to come crashing down after pretty decent earnings. But they came down because it just surged so high. And the same thing could happen to John Deere. We'll see about if I'm going to play John Deere at all. I'll know on Thursday. If it comes back down, I might sell a put. If it stays really elevated, I might buy a put in anticipation of them posting disappointing revenue numbers similar to what Caterpillar did. So what have I got going on at the moment? Well, let me go ahead and show you. So here we go. We got UPS. I sold a put on them with a $195 strike with an expiration date of the 19th of August. I collected $52 in premium. I'm currently up $22. What does that mean? Well, if UPS finishes above $195 by the 19th of August, I get to keep $52. If they finish below $195, I will end up buying 100 shares of UPS at $195. Now, on the subject of companies that are reporting this week, I've also sold puts on Lowe's. I've also sold a put on Target. In addition to selling puts, I also did buy shares. And I ended up buying 400 shares of Macy's. They report on Tuesday. I bought them at $19.93. So what I'm hoping is that Macy's might go up to about 24 bucks. I'll give you my bull thesis in just a moment. But right now, I'll give you my bull thesis on just retail in general. So what we're forgetting is that people have jobs. When they have jobs, they buy things. And because they buy things, retail sales rose more than expected in June. We also have to remember that Levi's had very good earnings in June and ended up hiking their dividend. If we look at the numbers reported by Levi's this past quarter, analysts expected $1.43 billion of revenue. They got $1.47 billion. Earnings per share were 29 cents a share versus the 23 cents that was expected. In addition, Levi's did hike up their dividend. Amazon also had the biggest Prime Day event this past July, selling 300 million items. And probably the reason why I'm the most bullish on retail right now is that Michael Burry is now taking aim at Target, saying he thinks the retail giant is in trouble, and he posted this on June 29th. Now, if we look at Michael Burry's recent track record, it's not been completely stellar, and I usually wouldn't poke fun at a guy just for being wrong about things, but this guy is so bombastic and obnoxious that I don't mind doing it. So let's see here. On the 29th of June, he's like, oh, don't buy Target. And so when we look at Target on the 29th of June, it looks like Target was about $141, and they're up 21.5% since. So yeah, I'm selling a put on Target. I probably should buy shares because Michael Burry says you shouldn't do it. And this is coming from the same guy that shorted Tesla here on May 17th. He revealed they had a $530 million bet against Tesla, only to close this out in November of 2021. And so when did he buy and when did he sell this thing? Well, he bought it when it was $500 and he exited at the very freaking top at what? 110% down. So this is Michael Burry. And what else did he do? Well, he also opens up a short position against Apple here in May 18th is when it's reported. And since May 18th, all Apple has done is go up about 25%. So this guy is the king of selling at the bottom and buying at the top. And because of that, I'm very bullish on Target because Michael Burry does not like it. Now what I really need is for Michael Burry to actually step up and hate Macy's because I've actually got 400 shares of that. So Macy's speeds up plans to open smaller stores outside of malls. And so what they're trying to do is they realize that their footprint is too large. And so they're trying to take some of these larger places and basically trying to consolidate their building footprint and open up smaller places. So they're trying to exit malls and they're opening up these little marketplaces they call Market by Macy's. I like this. Another thing that they're doing is they're getting pretty big into online retail. Their sales were, online sales are 35% of their total sales, down from 2020 to be expected, but up 25% from 2019. These online sales do apparently cut into their in-store sales, but maybe it does and maybe it doesn't, because who's to say that just because you bought something online that you were actually going to go to the store if you couldn't have gotten it easier? You might not have gotten it at all. And I'm not very bullish, to be honest with you, on online clothing sales because I'm one of these people that I feel like I need to see the clothes before I buy it. I might buy a shirt like this online because I don't care what it looks like. But if it's like something that I really do care what it looks like, I want to see it, I want to feel it. Not all larges are the same. And I might be a really lazy shopper if I'm honest, but at least put the shirt up against me and hold it up and say, yeah, that looks about the right size. And I'll do something like that before I buy it. But again, people do like to buy stuff online that are clothes. I don't personally do it because I don't like sending stuff back. If it was me buying stuff online all the time, I'd have a whole closet full of stuff that doesn't fit. And because I just wouldn't send it back, but that's just me. But people do like online clothing sales. I'm just not one of them. Another reason why I like Macy's is because they do a lot of stock buybacks. If you look at that, they've authorized $2 billion in stock buybacks. They've only bought back $1.4 billion in shares, clearing the way for another $600 million in stock buybacks. They bought back 17 million in February, and they bought back 6.5 million in April. And they've got room for $600 million more. Also, when you look at the valuation of Macy's, you're going to see that this company trades very, very cheaply. They've got a price to earnings ratio of 3.48. They have a forward PE of 4.39. They have a dividend of 3.16%, which is better than the 10-year bond yield. And so even if they do report poor numbers, given this price to earnings ratio and this bond yield, I wouldn't expect that I'm taking this huge chance that this stock price is going to collapse after earnings, even if they disappoint. I think we're already there. I think we're already near the bottom. So I feel like this thing could go to like $24 a share, and I'll cash out and make my money because I don't plan on holding this for a long time. But if I had to hold it, I wouldn't mind. It's not something I'm going to sell at some huge loss. I'll just stick around and collect that dividend. All right, another company that I plan on making a play on this week is going to be Tapestry. Tapestry is trading right around $36 a share. I'd like to get it around $33, $34 if at all humanly possible. I'm going to do it like Macy's. I'm going to go full bull. I'm just going to buy the shares and see what happens. I think it's going to go up. I think it's going to go up because Capri Holdings just reported a really nice quarter, and they're very, very similar companies. Capri Holdings does, let's see, they have Michael Kors handbags, Jimmy Choo, and Versace. And Tapestry is Coach and Kate Spade. So they're pretty similar. But the quarter that Capri just had showed them beating their earnings per share by 23% and their revenue by 5.78%. And I have to expect a similar quarter out of Tapestry. And if I can get it around $34, $35, that's what I'm going to do. Another company that I'm going to be getting into is going to be Applied Materials. I'm going to be selling a put on these guys. I'd like to probably do it right here about the $103 range. The reason why I'm bullish on Applied Materials is other semiconductor manufacturing companies have also done well this earnings season. We've seen good earnings out of Samsung. We've seen good earnings out of Kulicke & Soffa, out of Taiwan Semi. We would expect that Applied Materials would also report good, strong earnings. And so selling a $103 put doesn't seem like a bad deal at all to me. I'm also going to be getting into John Deere, possibly. See, John Deere's had the same problem that Caterpillar had running into earnings. They're at an all-time high. If they pull back here, say in the $330 range, I might sell a put here in the like $305, $307 range. If they continue to ride up, 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 I would expect that their earnings would look similar to Caterpillar's, meaning that they would beat on their earnings, but they're going to miss on revenue. They're going to do exactly the same thing, and then they're going to fall down. Perhaps buying a put at the money or maybe slightly out of the money on John Deere might not be a bad play when they report on Friday. All right, well, that's going to do it for this week. I hope you guys enjoyed the episode. I hope we all make plenty of money this week. Until then, we'll see you next time. Have a good day. Bye.